Warren Buffett just made one of his biggest moves of 2025. And no, it's not some flashy takeover or headline-grabbing stock pick. The real move is quieter, almost boring at first glance. He's sitting on an enormous pile of cash, holding back, and then carefully picking his moments. In fact, if you look closely, the secret move may already be in motion. To catch this new update, stick with us to the end as we dive into Buffett's record cash pile, the recent trades Berkshire's making, and what all this signals about his view of markets is. Trust me, this is a move every serious investor should understand. With being said, let's dig in. Let's start with the headline, because it's a big one. Berkshire Hathaway is sitting on a mountain of cash in 2025. Reports put the total, cash equivalents, and short-term treasuries at roughly $344 billion. That's not just a large reserve, it's one of the biggest cash stockpiles ever held by a U.S. public company. Now here's why that matters. Warren Buffett doesn't just hoard cash for the sake of it. He's been very open over the years about how much he hates sitting on money that earns little. If he's holding this much, it's not out of habit. It's a signal. For several quarters now, Berkshire has been a net seller of stocks, unloading more than they're buying and steadily letting the cash build up. So, what's the takeaway? Some market watchers believe Buffett's bracing for turbulence ahead, keeping what he likes to call dry powder, ready for when the market resets and bargains return. Others see it more as a statement of discipline, that he'd rather sit on the sidelines than chase overpriced assets. And if you know Buffett's style, that restraint is just as much a strategy as the eventual buying spree. So that's the first part of the secret move. Build the war chest. Buffett is setting up optionality. And the real question is, optional for what? That takes us to the second part of the story. The actual trades Berkshire's been making behind the scenes. Now having that mountain of cash is one thing, but where you choose to deploy it is everything. And if we take a closer look at Berkshire's recent moves, we can start to see how Buffett and his team are positioning themselves. One of the most notable new stakes is in United Health Group, worth about $1.57 billion. That's a fascinating choice, because health insurers right now face regulatory scrutiny and rising cost pressures. So why make the move? It signals confidence that, over the long run, the demand for healthcare and the role of giants like United Health will keep growing no matter the short-term noise. Then there's Nucor, a big name in steel. Steel may not sound flashy, but it's directly tied to infrastructure spending and industrial demand. Pair that with positions in Lennar and D.R. Horton, two major home builders, and you start to see a tilt. Berkshire is leaning into real assets and housing-related demand. It's not chasing the AI or tech hype cycle, it's putting money into sectors tied to fundamentals. We also see increased exposure in Constellation Brands, a play on steady consumer demand in alcoholic beverages, and Pool Corp, which benefits from home and lifestyle spending. On the other side of the ledger, Berkshire has been cutting back or fully exiting names like Citigroup and Brazilian fintech Nubank. Put it together, and a pattern emerges. These aren't wild, high-growth moonshots. They're selective, measured bets, often in cyclical or rebounding areas of the economy. And all the while, the core pillars remain untouched. Apple, American Express, Coca-Cola, Bank of America still anchor the portfolio. So what's the message here? Buffett isn't tearing down the house. He's reinforcing it while keeping a massive reserve on hand. He's quietly rebalancing, tilting into areas he thinks are undervalued or overlooked, while that $344 billion cash pile gives him flexibility to strike when the big opportunity finally arrives. And that brings us to the bigger question. What does this secret move tell us about Buffett's outlook on the market as a whole in 2025? Now here's one of the most revealing moves in recent news. Buffett is reportedly close to acquiring Occidental Petroleum's petrochemical division, OxyChem, in a deal worth around $10 billion. This would be Berkshire's largest acquisition since the Allegheny deal in 2022. What makes this deal interesting is that Buffett is doing this in cash, not exchanging stock. And he already holds a large stake in Occidental, around 26 to 28%. OxyChem's business is in chemicals used in sectors like water treatment, battery recycling, and paper. It's less glamorous than tech, but tied to industrial fundamentals. This move would reduce Occidental's debt burden and refocus some assets. This is a big signal. It suggests Buffett is not content just sitting on cash. He's using it when he sees structural value. And this move into industrials/chemicals also hints at where he sees pricing power or durability. So the secret move isn't just he's got cash or he's buying stocks. It's using that cash strategically, with restraint and selectivity. So, what do we take away from all this? First, Buffett is clearly signaling caution. While plenty of investors are stretching for returns in what many would call an overheated market, Buffett's been quietly doing the opposite, selling more than he's buying and letting Berkshire's cash pile swell to record levels. That's not him panicking or running for cover. It's discipline. It's a message. If prices don't make sense, I'll wait. This is classic Buffett. For decades, he's preached that the biggest mistakes happen when investors feel forced to act just because the crowd is chasing something. Right now, with valuations stretched and speculation everywhere, he's reminding us that patience is a strategy in itself. Sometimes the smartest move isn't to swing at every pitch. It's to sit tight until the right one comes straight down the middle. Now here's where it gets interesting. You see, by holding back now, he's not missing out. He's setting himself up. Because when markets eventually cool, or a big opportunity emerges, he'll be one of the only investors with the cash ready to move. Second, notice where he's actually putting money to work. Buffett isn't chasing whatever's trending on social media, or the stocks that dominate headlines for a few weeks. Instead, he's quietly leaning into sectors that almost every economy depends on: healthcare, housing, industrials, and real assets. Think about it. Healthcare is a long-term play because people are living longer, populations are aging, and demand for medical services only grows. Housing has always been a backbone of the economy. No matter what, people need places to live. Industrials and steel? Those are tied to infrastructure and development, the kind of real-world demand that doesn't disappear with the next tech fad. And real assets, businesses that produce or distribute essential goods, hold their value when other things get shaky. Buffett knows these aren't flashy. They won't double overnight. But that's exactly the point. These are businesses with staying power, with predictable demand, and with the ability to compound steadily over decades. By placing his bets here, he's signaling that he values resilience and durability over hype and momentum. Third, and maybe most important, he's showing the real power of optionality. A giant cash pile isn't just sitting there collecting dust. It's flexibility. It's freedom. Think about it. Most investors, when a crash happens or an opportunity shows up, don't have spare capital lying around. They're fully invested, or worse, over-leveraged. Buffett, on the other hand, has built himself a war chest so that when the market finally blinks, whether it's a correction, a liquidity crunch, or just a once-in-a-decade bargain, he doesn't have to scramble to raise cash or sell something at a loss. He can strike instantly and from a position of strength. That's how he was able to scoop up deals during the 2008 financial crisis when everyone else was panicking. It's how Berkshire has negotiated favorable terms with companies desperate for capital, because he had cash ready when no one else did. Optionality is underrated. It's not about timing the market perfectly. It's about being prepared so that when opportunity knocks, you don't miss it. And that's a lesson regular investors can take too. Holding some cash or liquidity isn't a weakness. It's a strategic advantage. So, what's the forecast? Most likely, we'll see Buffett deploy chunks of that $344 billion slowly, selectively, over the next few years. Maybe when a correction opens up better prices. Maybe through strategic deals where Berkshire already has an inside track, like the way he's doubled down on Occidental. But don't expect a buying frenzy. That's not his style. And for the rest of us, there's a bigger lesson here. Patience pays. Discipline matters. The ability to wait for the right pitch and not swing just because everyone else is swinging is one of the most underrated advantages an investor can have. Buffett is reminding us that sitting still can be just as powerful as moving fast. We can clearly see that in a market that rewards noise and speed, Buffett's secret move is showing us the opposite. Sometimes the smartest play is simply to prepare, wait, and be ready for the moment when value finally comes back into reach. Overall, the secret move Buffett made in 2025 is deceptively simple. He didn't rush. He built one of the biggest cash war chests ever, sat on it, and then quietly started investing where he sees value. That's classic Buffett. Measured, disciplined, opportunistic. So, which of Buffett's new positions do you find most interesting? Let us know in the comment section below. If you got value from this, give us a thumbs up and hit the subscribe button to keep tracking big financial moves like this.